Good morning, everybody, and welcome to this week's weekly analysis session for Monday, 14th of December. Hopefully, everybody's had a good weekend, nice and sunny in Melbourne. Not too sure what's going to happen during the course of this week with the FOMC. Certainly, Friday night in the US was fairly volatile. The disclaimer: the content of this presentation or any other Elite Traders Club session does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, or particular needs. So before making an investing decision based on the general advice presented in any of the ETC sessions, please consider whether that advice is appropriate in light of your financial circumstances. All right, so today we'll go through portfolio management, having a look at the benchmarks. We'll also go through and have a look at any specific setups. Now, there weren't a lot this week. There was only 2 in the Australian market, and there were no new setups in the US. In fact, over the last 7 or 8 months, I think it was the smallest number of scan outputs in a scan that I've seen. I think there was under 20 outputs, which is really very, very small. And obviously going through that 20, there weren't any setups there this week. Also go through some trailed stops and some stop outs in the portfolio as well. For the time being, we remain in very high market risk in the Australian market. So that means that we need to apply a 20% market risk multiplier to whatever capital we're allocating to that market. In the US, our S&P 1500, we're in moderate market risk for the time being. So we are applying an 80% market risk multiplier to the value at risk that we are allowed to allocate to that market. So if we go through and have a look at that, then what that means, if we're splitting our capital between 50-50 between the Australian market and the US market, that would mean that assuming we are allowing ourselves a maximum allowable drawdown of 15% in our portfolio, therefore half of that is 7.5%. So of that, we need to apply a 20% market risk multiplier. So that's like applying the brakes to that portfolio, if you like. And so therefore that's slowing us down, and it means that of our total capital, we're only allowed to have 1.5% exposed as value at risk in the Australian market. Conversely, in the US, our other 7.5%, if we're splitting it, we're applying the brakes a little bit more gently there. We're using an 80% market risk multiplier, so that's slowing us down from that 7.5% level down to 6% value at risk allocation across our portfolio for the US. All right, last Friday's macroeconomic session between myself and Jeff, we talked at length about the forthcoming FOMC. The fact that at the moment there are a lot of people on one side of the market. The market's been going up in the US for quite a number of years now, whether it can continue to go up or not. More importantly, I guess if we're looking at the US dollar, what's going to happen there? Is the Fed going to actually increase and formalise the new rate over there in the US, formalise it at 0.25? We'll have to wait and see. Certainly the bond market at this stage has been moving downwards. So a lot of people on that side of the trade. We just did a little bit of pondering. What would happen if the Fed didn't do anything this particular week? A little bit of uncertainty about some things going on in China at this point in time. What might that do to the bond market? What might it do to the share market? Certainly makes for a very interesting week. The education session last Wednesday was on the scanning process. So those of you who are having a little bit of trouble with that, some of the newer members, certainly feel free to go through and have a bit of a look at that as well. And by all means, request a coaching call if you'd like some assistance with that. In the new year, we did talk previously that we would be running sessions of a Friday afternoon just for the Australian market and doing a Monday afternoon session for the US markets as well. We are going on break. The office is closing on the 23rd of December, coming back on the 4th of January. So there won't be any ETC sessions during that particular time. Good time to have a bit of a break and reassess. How have you gone this year? Have a look at your portfolio from when you first started following ETC, the beginning of the year or whenever. How have you gone? How have you gone compared to the market? Have you made money this year? If you've made money this year, that's a huge tick. If you've managed to hang on to your money and come out square this year, that's actually a huge tick as well, because the market has gone down. So if you've been able to hang on to all your capital while the market's been going down, that's fantastic. That's the name of the game. If you've donated, if you've had some losses this year, well, have a look at those losses in comparison to what the market has lost. Your job is to make sure that if the market does fall away to the downward side, that you don't donate any more capital than you absolutely have to. And that will always be the case. And if you follow your trading process properly, then I'm sure you'll find that if you do have any losses, that they'll be much smaller than what they need to be. All right, let's go through and have a look at the markets. I'll just bring up our Beyond charts here and go through and have a bit of a look at our indices to start with. So there's our XJO. You'll see that we've been below 60 for a long, long time, since June of this year, and we really haven't looked like getting anywhere near back above 60 for a considerable amount of time. Markets really struggled. We've tested this 5,000 level on a number of occasions, and it looks like we're going to test it again today. And it just remains to be seen whether we're able to hold on to that particular level. In the US, by comparison, slightly different picture over the longer term, if you like, over the last 12 months. This has been a market that has been pretty much a stairway to heaven, really, over the last 4 or 5 years. But since moving sideways for the better part of the first 6 months of the year, the market, you'll remember, capitulated through August, September. A lot of volatility. Coming back up and testing old levels on its way back up. This old level here, this old point of supply, acting as another point of supply in the future. Eventually, then, when it was broken, acting as a point of demand, acting as a point of demand again, and now it's broken through that particular level. It remains to be seen whether we can find any points of further points of demand through here that may well hold this up. So this old point of demand here that has now been broken, we're really looking for any further points of demand down through this level, and there's not really a whole lot of them other than down at the sort of 460 level. So that's the first area that I'm going to be looking for some support, some points of demand during the course of this week. And failing that, then it's anyone's guess. Certainly, let's go through and have a look at some new setups for this particular week in the Australian market. There are only 2 this week, and one of them was on Blackmores, and this is a stock that's already in the portfolio, so it's an opportunity to add. The only aspect of this, as far as the trade setup goes, is, as you can see, it's going to have a fairly wide stop. But in terms of our price action filter, last trough, at or above, second from last medium-term peak, it's well above. So very, very strong price action. If we zoom out, you'll see we're at all-time highs. So certainly a lot of strength in this particular stock. And I know a number of people who are on this and have been in it all the way through from the initial entry and are still in it. And they are doing exactly 100% everything right. The only way we need to exit is when price closes below the trailing 3 ATR, and that's a long way away below in this particular example. So we do have another setup. Price just needs to break through this last medium-term peak. So we have an on-stop order at $201.04 and a protective stop coming in at $155.22. Now, traditionally, we would have said that stop there was a little bit too wide. It's a volatility-based stop, so that means it's a stop that's based on how much this stock has been moving up and down. And so from that point of view, whilst in percentage terms it is quite a long way, it's still, in terms of measure of movement, it just means that this stock moves a lot more than a number of other stocks. So yes, it is certainly well and truly outside of sort of a 10 to 12% risk. But again, you can adjust your position sizing accordingly to make sure that you don't have more capital at risk on that than you should. That's BKL. The other stock this week that set up was Elders, a stock that's been gradually improving in its longer term performance and medium and shorter term. Last trough that's just been created is now above the second from last medium term peak. So all we need to do is zoom out and just make sure there's nothing overhead that's going to get in the way. Now if we scroll out, what you'll get to see excuse me, is a long-term peak, and that's coming in at around about that $6.44 level. So if we take that into consideration, do we have sufficient space between where we're looking to get in and that longer term peak that we can get at least 2 to 1 on the setup? And quite clearly from a visual point of view, you can see that. Plenty of room between entry levels and that next level, that next ceiling, that next major point of supply. So the on-stop order for this is at $4.78. You can have a limit 0.5% above that. Our protective stop is at $4.20. Now that's at least 2 ATRs away from our entry, and it's at least 0.5% below that last medium term trough. So that's the setup there on Elders. During the course of the week, a number of cancellations from the ASX watch list. Now I won't go through every single cancellation in the watch list, only because there's quite a few in the US in particular, but I will go through the Australian ones. Bega was one that's just recently, you'll see the price action. We've now got short-term downtrend, so therefore we've had the formation of a lower medium-term peak. Wherever this trough forms, the one we are now in a short-term downtrend, whenever that turns around and starts moving up, that trough, wherever it is going to be lower than what is now our second from last medium-term peak. This was the second from last medium-term peak, but now that we've had another peak formed, the second from last medium-term peak is this one, and this trough, wherever it forms, is going to be much below that, and that will therefore invalidate the price action filter. So Bega is one that's coming out of the watch list. The other one, CGF, Challenger Group, or Challenger Limited rather, similar sort of thing. We're in a short-term downtrend. Wherever this trough now forms, that's going to be lower than the second from last medium-term peak, and that's that one there. So that one is coming out of the watch list, and NHF, the other one as well, coming out. And again, similar sort of thing. We've just had a new medium-term peak formed. Wherever this trough ends up forming, it's going to be lower than what is now the second from last medium-term peak, which is this one. So therefore, on that basis, because this new trough, wherever it forms, is going to be lower than that, that invalidates the price action filter, and so therefore needs to come out of the watch list. In the US, there were 15 cancellations, and you can check these out in the watch list. I'll just call them out now. ATO, AVY, DHR, AEIS, ALGN was a setup that has now been cancelled. Amazon, AMZN, CHE, CINF, CSH, and ELY. Also LEA, SBNY, T2, that's TTWO, SYKE, and TXN, all coming out of the watch list because of weakening price action. So similar sorts of concept as to those in the Australian markets, the ones that we went through. What I would like to do now is to go through the Australian Open list and have a look at those trades that have trailed stops on. So in the Australian market, there was one stock that had a stop trailed on it last week, and no prizes for guessing this one, Blackmores. And there we go, we'll pop our 3 ATR on, and you can see last week's candle there dragging that 3 ATR line up even further and further again. So whilst this is also a new setup, it continues to drag that trailing stop up higher and higher. So the initial entry for this one was around about $80. So we're locking in pretty much 100%, getting close to 100% gains on this one by purely considering where the trailing stop is at this point in time. There has been a price volume volatility signal go off on this previously at around about that 160 level. So if you've taken off, some profits along the way, fantastic. That's exactly what you're supposed to do. Only taking off half your profits and just being patient and letting the trailing stop do all the hard work for you. You don't need to make it any more difficult than that. The stop outs in the Australian portfolio this week, JHX. If we go through that one there, James Hardie. You'll see that last week's candle, this has really been struggling. You can see the wicks, interestingly, on the upward side there, starting to push price down. And last week, big black candle closing below its trailing 3 ATR. So that one is coming out of the watch list. So coming up with around about a scratch trade on that particular setup after having been in it for most of the year. So probably a couple of dividends along the way there, but no damage to the portfolio. If that was in yours, TPG, this is a stock that's done pretty well over the last few years. But just recently triggering us in, and obviously with the broader market weakness being caught up in that a little bit, and now closing below its initial 2 ATR based stop. So from that point of view, choosing a market exit this morning on TPG Telecom. The other one on the list, ResMed RMD. So if we go through there and have a look at RMD, it was one that was starting to increase in terms of its relative strength. Some nice white candles coming through. Nice trough coming in there. Trough at or above second from last medium-term peak. However, upon triggering, all it's done since then is turn around and go the wrong way. That will happen from time to time. Hopefully it doesn't happen on every trade that you get into, and that's why it's so important that we've got an exit strategy. And our exit strategy is simply when price closes below your initial 2 ATR based stop, okay, that means we need to get out. So the previous week we had price come down, it actually moved below our initial stop, but it didn't close below. So from that point we're still in it. The following week price is now closed below it, we need to get out. So we're really giving it every opportunity, and now we're saying, right, it's time to exit. Okay, so every big loss that anyone has ever had always starts from a small loss. We've just got to make sure that we contain those small losses. That's the first part of your job. The second part of your job is, once you're in a trade, is to manage it appropriately and let your profits run. Okay, so as you can see in stocks like CZZ and Blackmores, by doing that you will be well rewarded. All right, a couple of price volume volatility signals whilst we are still in the ASX market here. CKF, Collins Food Group, or Collins Foods Limited, price volume volatility signal. So remember, this signal goes off when price has become stretched, so a multiple of ATRs. So as an example, if the makers of Kentucky Fried Chicken here, CKF, Collins Food, if its average trading range, let's say hypothetically, was 40 or 50 cents, then because this stock has moved a multiple of that trading range, okay, 4 to 5 times that level, and at the same time having a increase in volume during that particular time frame, and you'll see down the bottom there where I'm just moving this at the moment, just to the left of that we've got volume, and we've got a little blue line. That little blue line is just an average of the volume. So it's a 63 period moving average of the volume. And you'll see, if I just move that out of the way there, that last volume measure there is above that 63 period moving average. So it's had an increase in volume, but at the same time, what's important, it's also had the formation of a bearish candle. And that's why the signal's gone off. Now, typically, when the signal goes off, we don't want to be taking part profits unless we're up 2 to 1. Okay. Now this is clearly up 2 to 1. In fact, it's close to 2.5 to 1. So certainly taking half off the table on that particular move makes sense. You're still in the other half, so if it continues to move on upwards, you'll benefit from that. If it happens to move down in the opposite direction, well, you're still going to end up profiting more than likely on the basis of that move as well. So it's just smart trade management. We're not taking it all off the table. What we're certainly looking for, though, if we do get some strength in the market, is to look to add back into the trade should the trade set up as such. So that's CKF, which had a price volume volatility signal. The other one, ARB Corporation. Again, we've been in this one for quite a period of time. It's really gone sideways for the best part of the year, but just recently starting to move up with some nice price action, a series of higher troughs. And last week, that price volume volatility signal going off. So if you think about where we've entered, are we up 2 to 1 on the trade? Yes, we are. So certainly taking half off the table at that level makes sense, and therefore just looking for another opportunity. In the US last week, we had some stop outs. So let's go through and have a look at those that were stopped out. UHAL. Last week, price no sooner than being triggered in, and again, a couple of big black candles closing now below our initial 2 ATR based soft stop. So remember, it's a soft stop, so if price comes down during the course of the week but it closes above it, that's okay. But last week closing below it, so therefore now it's a market exit tonight. LI, Lennox International. This is a stock that's been in the portfolio for a while. Now, this is the second position that we had on this one. So adding to the position, if you already had it, you could have done that. Or alternatively, it may have been a brand new setup. Just being triggered in, price coming down, 2 weeks of bearish price action there. Price now closing below our initial 2 ATR based stop. So market exit tonight. That's Lennox International. We still are in that from a setup earlier in the year, and still going along quite nicely with that. You can see the ATR line is a long way away, so the previous levels there, the previous setup, still in the portfolio. It's just the more recent one that has come out through the stop out there. AHL, so Aspen Insurance, similar sort of thing, triggering in the last week, looking quite strong, a lot of white candles, etc., looking really nice. Last week, again, a big black candle closing below. We need to exit, so that one's coming out of the portfolio as well. AHL, BXS. A similar sort of story, just being triggered in the previous week, and then last week, big bearish candle closing below, a market exit tonight. And two others, CACI, Catchy International, similar sort of thing. Again, big black candle last week, and no surprise given what was happening on Friday in the US. And the last one, TXN, was looking TXN. Yes, that's the stock code, which is I might have to bring that up. Texas Instruments. I'll bring that up. That was in the portfolio. There it is. There. Just bring up that setup, and there we go. So I'll just zoom in a little bit on that one when Beyond Charts decides to oblige. There we go. So this one here being cancelled. Actually, no, it wasn't a stop out. So excuse me, it wasn't a stop out on that one. That was just one that was a cancellation as opposed to a stop out. And a cancellation because now we've got price action. We've got two peaks. We've got a lower peak formed. So wherever this trough forms, is it at or above the second from last peak, which is now this one? No, it's not. So it invalidates the price action. So that one wasn't a stop out. One that was, I think I've got them all there. CBU, I'll just go through that one there. Community Bank. That was one where we triggered in the previous week. Price is now well and truly closed below its initial 2 ATR based stop, so that's an exit at market tonight. Trailed stops while we are in the US. I think it makes sense to have a look at both sides. Vail Resorts, MTN. Again, this is a stock that took a while for this stock to trigger, and then disappointed a bit by, sort of going sideways and not really going anywhere. But since, the last couple of months, particularly through October, November, into December, has really started to outperform the market. And you can see that, the relative outperformance is increasing all the way through. So very strong performing stock. And last week's candle gapping up and closing even highs, and that's been dragging that 3 ATR line well above break even now, so that's a very strong sign there. Strong performance, MTN and Casey, CASY. Another one as well. So remembering that last candle there, doing all the heavy lifting, dragging that trailing 3 ATR up as well. So one of the things you do need to concentrate on, when you are learning how to trade and learning how to manage your capital, your positions, as always is the case, focus needs to be on protection of capital. So making sure that you're using your protective stops and making sure that the losses you have are small. On the same hand, you can't continue to have small losses without letting your trades progress to give you larger wins than your average loss. It just won't work. You can't limit your gains and limit your losses at the same time and expect to make money. So you have to let your profits run. So you have to be patient. You have to be boring. You really, to make it easy, will be best served by using this little trailing line, the 3 ATR, and that's going to give you the best chance of being in stocks and really bagging a winner. So a lot of people will say, David, well, look, how do I find stocks like Casey or Blackmores or GPN or any number of them that have performed really well this year? Well, the question is, you don't. The question really should be, how do I get out of those stocks? Okay, so how do I get out of a stock like GPN as an example? Global Payments, which has been a strong stock more recently, that's been entered through $53. It's now up $70 odd. So it's put on $25, or pretty close to it, from initial entry. So that's nearly 50%. Well, you should still be in a stock like this. I wonder how many people who may have been in this, but risking $3 or $4 and got out when they were $3 or $4 up. You're never going to make any money doing that. You need to be patient and let your trades evolve. The classic example we've seen in the Australian market is Blackmores, but also Capilano Honey. AHD, as an example, has been a good performer this year in the Australian portfolio as well. Continuing to move up, higher and higher, risking $1, and now it's $4 up. So that's that would basically allow you to have 4 losing trades for 1 winning trade. So you only need a couple of these in your portfolio to make all the difference. The market this year has gone downwards. So if you've got a portfolio that's got exactly the same amount of money you started with at the beginning of the year, you've actually outperformed. You will have done better than the professional fund managers. So that's what you need to keep in mind when you're thinking about, managing your own portfolio. Capilano Honey, another sort of example there. That's not a very good picture there. Something's happened with my Beyond charts. There's Capilano Honey. Basically a little over $1 of risk on that particular stock. It's gone from $12. It's now sitting at $20. So that's 8 to 1 in terms of your initial risk that you were taking on your trade. But you only get to be in these trades by managing them accordingly. When you get into this, you don't know what it's going to end up like. It could have been pipped in and turned around and gone the other way. That's just part and parcel of being in the market. So it's really, really important to be patient and to manage your trades in a very simple, easy to do manner. If it's easy to do, then the chances are that you'll repeat it. And if you repeat it, then over the longer term, you're going to get some fantastic results, and that's going to make such a significant difference to your overall performance of your portfolio. So continue to focus on that particular theme. If you'd like a portfolio review, how you've gone this year, then certainly just request a coaching call. Myself or Jeff be happy to have a discussion with you and talk you through that to make sure that you're on task and you're focusing on all the things that are important. All right, well, that's about it for me this particular week. We are having a break, as I mentioned, closing on the 23rd and coming back on the 4th. There will be one more weekly analysis session. That's next Monday morning. So until then, it's bye for me.